today. Mel James, Principal Buyer Agent, James Buy Sell. And as you're aware with these podcasts, we're here to bring you the big players in top-end Melbourne buying and selling. And there's not too many players bigger than this particular man, Grant Rheuben. Welcome, Grant.
Thanks, Mel, for having me.
I'll start off with something pretty flash. He's just been voted #1 mortgage broker in Australia out of 15,000. We've known Grant for about 15 years, done a number of deals together for our clients, and I'm really looking forward to this particular interview. So Grant, tell us about the award then before we get going.
Yeah, so late last year I was awarded Commercial Broker of the Year for Australia through the Australian Broking Awards, and then that culminated at the night to be awarded the Australian Broker of the Year. So it was a very humbling experience, but something that I was very proud of. When you consider there's 15,000 brokers out there in the marketplace, it's an amazing achievement and real testimony to everything we've done over the years.
Let's start off with a couple of quick questions about you and what you do. So number one is, how long have you been a mortgage broker, or have you always been a mortgage broker? What did you do before?
Yeah, I've been a mortgage broker for 20 years, so it wasn't my first profession. I previously worked as a chartered accountant.
Gee, that was exciting.
It's probably the reason why I left.
Yeah.
And, you know, I think things happen for a reason, and as an accountant, you do everything in the past. So, and I just wanted to proactively help people, and I sort of had an attraction to finance and property, and I thought, you know what, helping people get finance to accumulate property is something that's proactive rather than the reactive skills of accounting. And then I use those accounting skills each and every day in what I'm doing today.
And next question, kids, family, holidays. Now, I'm very familiar with Caroline because I think we did buy your house, and you actually paid us a fee. We bought your house for you 15 odd years ago in Caulfield East.
Yeah,
So,
16 years.
16 years ago, there you go. So kids, family, holidays,
Yeah,
if you like going.
Married, wife Caroline, got 2 boys, Josh is 17 and Zach is 14. Recent holidays, we went to Italy, Israel, and New York, Washington, and LA.
Oh, so it wasn't just down the coast. Okay.
No. We work hard and like to
Play
reward
hard.
ourselves.
What I think this is a question I've always been interested in. What do smart buyers and sellers do about mortgages?
I think the most important thing a smart buyer can do is, you know, not look at the internet, not troll for interest rates. I think a smart buyer and someone who's looking for a loan, they should seek out a trusted advisor. It's a very hard lending landscape to navigate these days, and so I think you need a trusted advisor on your side. And you know, I just want to highlight, we're helping one of your clients at the moment. They rocked up, or they were thought they were ready to buy, and the day they were going to make an offer, their broker said, sorry, we're not ready. And one of the most important things you can do as a buyer is be bank ready. And so what we've taken on that customer, we've understood their story. They had an income trajectory that was like this.
Well, they were a doctor, so yeah, they've been. I agree with you, and I really like what you're saying about bank ready. That's a really good term. I think a lot of people think they're bank ready or just assume they're bank ready, but in many cases they are not bank ready, even though their income says they should be, because they're talking to the wrong people.
That's exactly right. You got to know what to say, how to say it, and who to say it to at the respective bank to get the right outcome.
Good. I think another thing for smart buyers and sellers about mortgages is eventually they get rid of them. But anyway, we'll see how we go. Probably the same with agents. The biggest job you've been involved in, and perhaps the most sort of challenging. You know, no names, no pack drill, if you don't want to. But yeah, let's talk about it.
So, as a finance broker, and what we do in our business, we help clients on the residential property side. We do a lot on the commercial property side. So we do everything from first home buyers through to high-end professionals buying high-end property, and then we help business owners, money for their business, commercial property, and probably the biggest transaction we've done is a $30 million shopping centre loan. So someone built a shopping centre for worth about 55 million in value, leased out to Woolworths, etc., and we funded that for 30 million. So that was a very exciting transaction. The most challenging job we've done, I put it into a bucket, anything that related to COVID. We had a lot of customers who were in COVID impacted industries, hospitality, accommodation, and these people didn't sign up to be in those industries. They just got dealt a really hard hand. And some of those people needed to buy property, needed support in these times within their business, and a lot of the work we did was unrewarded, but it was just really helping those people get through to the other side.
I think that's a little plug I'll give you before I ask you the fifth question. The reason I like you so much, Grant, and why I think our customers like you, and we don't receive any referral fees, there's no financial connection between Grant and myself, is that you actually genuinely care. And another thing is you don't lie. And in our industry, to be frank, that's pretty unusual. So well done. So it's sort of welcome back in a part two, because we started this podcast last week, and then the absolute loudest cement truck that you've ever heard in your life came and parked themselves right out the front of ours and wouldn't go away for an hour. So anyway, thank you very much for coming back, Grant.
And I've worn the same suit.
You have, and I've tried to remember what I was wearing last time, and we'll see how we go. But let's focus in on the big issues of this particular podcast, and they are basically three things: getting finance, watching rates, and then how you use money when you're buying and selling property. Let's start off with somebody who's looking to get a mortgage, e.g. a first home buyer or an existing home buyer or an older buyer, and let's just try and find a top tip for each rather than of thing. So with a first home buyer, what do you think is the most important tip that you would give them?
I would probably give them a couple of tips. The first one would be is understand what is your repayment going to be, and what are you actually paying in rent, or what are you saving per month? And if you're saving $2,000 a month and your repayment's going to be $3,000 a month, you're not ready to be buying.
Okay, that's a good point.
Secondly, I think you've got to understand how you can get into the property purchase. So do you have savings? Is the bank of mum and dad there to help you? And thirdly, the government now has a number of initiatives and arrangements to help first home buyers. And when I say that, it's only for people who buy a house to live in.
Right.
Those incentives are not available for investors.
But let's really focus in on two areas where we do a lot of work with. And basically that is somebody who's in a property at the moment and they want to get a bigger property. So they're 43 kids, they're in a $2 million single fronted, and they now want to go and buy their forever home or their main family home, so they can see their kids growing up, and that's probably going to be like a $4 million home. I suppose the first question is buy and selling, and you have to do both. Do you buy first? Do you sell first? What are the issues do you see in that?
I think first up, and we get customers, our clients approaching us with this situation on a regular basis. First of all, I would recommend to clients that they organise a pre-approval for the amount they want to buy for, subject to the sale.
Yeah.
And that gives them a starting point of what they can afford. I think, and then secondly, I think you've got to look at, what is your maximum purchase price, and then on the downside, what is your lowest sale price?
Right.
And
that's where we come in a lot of cases, giving people that sort of advice, like having some agents go through their property, or even us just giving a bit of an opinion and say, well, let's take a conservative view here. If we're buying first and selling second, let's take a conservative view of our existing home. And similarly, if we are buying first, well then this is probably the budget you're going to need for that sort of property with your
Yeah.
PPPs, and if you can't quite find what you want in that area, then you've got to adjust one of your other Ps, which is that position. So I totally agree with you. So buying first and selling second. Obviously, then the issue is a transitional loan, or what's the correct word? It's
bridging
finance.
Thanks.
Bridging finance. What would be your tip in that area?
Well, first of all, for anyone to be able to complete a bridging type transaction, bridging finance, you need to have equity in your current home.
Right.
For example, very simply, if you have a house worth $2 million and you have a loan worth $700,000, you have equity.
Yep.
And then you've got the ability to
have $1.3 million in equity.
Yep. If you come to us and say, I've got a $2 million home and I've got a $1.6 million loan, you do not have enough equity to achieve a bridging finance scenario.
Because the bank is going to allow for a discount on what they think the value of your property is. So they may well say, I know the market says your property's worth $2 million, but we in the bank are only doing calculations on 1.6. Your loan's 1.6, so we can't really help you.
That's right. And then for majority of people then upgrading, they need to borrow the whole purchase price because the equity is giving them the leverage to buy something better and bigger and higher in value. Now, if you've only got $400,000 of equity, you're not going to get very far when you're trying to borrow the whole $3 million purchase price of your second property.
So in that circumstance, you really do have to sell first. You have to get the funds from the property. Hopefully they're sufficient, and after expenses, on that 2 million 1.6 scenario, after expenses, they're probably only going to be a couple of $100,000 anyway. So you're going to have to do some more saving. You're going to have to spend some rental time and a few things. So maybe you need to ask yourself the question, are you ready to trade up yet?
Well, that's fair enough, but everyone's got their own story. And, that person might have 200,000 in shares and they liquidate those things. So every situation can create an outcome, but I think as a starting point with bridging finance, you have to have the equity.
Right. Okay, and basically if you do it the other way around, selling, you're not going to need the bridging finance, but then there are some issues that are perhaps non-mortgage broker issues that you are out of the market. And while we all assume now, maybe the market will drop or something will happen, we think we know what's going to happen in the next 6 months. We don't really know. And if you're out of the market for a year or 2 years and the market takes off like it has many times in the past, you're actually creating a bit of a problem for yourself. I think we started to touch on a little bit last time about a particular client that thought they were bank ready, to use your words, went in to buy a house with us and found that they couldn't. They have actually in the last week since bought a house, so in between these podcasts, and that's purely down to the fact that, partly down to the fact that we were able to help them, partly down to the fact they are flexible enough to get some additional help from you. And that's included, I think, some bridging finance and some various other things.
We had them approved to buy, subject to the sale. They've now bought, but they've bought with a longer settlement date. They've already aligned an auction date up for the sale of their property, and we'll make the dates align.
I think that's really important. Getting the right sort of mortgage broking, getting the right sort of bridging finance actually allows you to get a better deal buying and allows you to get a better deal selling because you've got greater flexibility. Whereas if you go and do something with poor bridging finance or no bridging finance or a poor relationship, it really means that you're under the pump. Immediately you've bought to try and get it sold. And in a market such as this, which is not absolutely flying, then that may mean you've got to take the first offer, and that may not be your best offer. So I like that. Let's move on to the older buyers. Perhaps not talking about myself here, but look, I get the general opinion that the older I've got, the more banks dislike me. Yet I feel that my assets have been they're getting higher, my income's getting better, and yet for whatever reason, and it feels to me age. And I'm sure there's an official political response, but let's just try and keep it real. As you get older and older, banks seem to be less keen in lending you mortgages on a longer situation, I suppose, obviously because they think you're going to die. But it makes it harder for the bank of mum and dad, for instance. You were the one that helped me. I had to move banks from one of the big four banks, if not the biggest bank. I had to move them to one of the newer banks. I had to move all my banking to that situation because I did want to help my children in purchasing properties, and I could not do that. They would not lend me the money to assist there that were bigger banks. Do you feel that the older, it's a roundabout question, do you feel that older people are sort of dealt with more harshly, or is there some way that you can deal with it better, or?
The banks want to understand what is your exit.
Mm-hmm.
And I think it's, again, having a strong mortgage broker on your side to explain the story of you as a customer and your age and what your plans are over the 5-10 years.
Yep.
And what it's about is, if you've got a loan, you apply for a loan at, anyone who's over 45 years of age, they are applying for a 30-year loan, and their loan is still going to be going, if they paid the minimum amount every month for 30 years, they will have finished their working life prior to that loan expiring and being repaid to zero. So
if they're smarter than me, I may still be going at that stage, but we'll see how we go.
But so obviously if we're assisting a client who's 65 years of age, they want to help their kids get into a property and give them $200,000 as a deposit. Can that person afford money? Can that 65-year-old person afford money? So they've got equity in their house. Great starting point. Now, are they still working? So some of those borrowers may still be working. We, as brokers and as banks, have to demonstrate affordability. So if you're 65 and not working with no income, we're not going to be able to get a loan. If we're 65 years of age and we've got a super fund, self-managed, we're generating a pension, we've got income streams coming out of that super fund, we can help you. And we know, and you might say, well, and the bank will give you a 30-year loan. They're not going to make you enter into a 5-year loan because it's going to throw you under a bus. You're not going to be able to afford the repayments on $200,000 for 5 years. That's 40 grand a year. Now you don't want that obligation. So we'll give you a 30-year loan, but then we explain to the bank, well, you've got $1 million in super. We're helping our children get in. We'll have the loan for a few years, and in maybe 5 years, we'll take a lump sum out of our super and pay it off.
Got it.
So it's all about understanding what is the exit. A lot of your clients would also be in the position they may be downsizing. They might have the family home they've had for a lot of years that's worth $5 million. They want to sell that property and move into a $3 million property.
And that's in that situation, almost all of them want to buy first because they don't want to be moving several times.
So in that situation, I talked before about end debt. The end debt position for that client is going to be zero. They're buying for $3 million. They don't have the cash because it's all tied up in their $5 million property. They have to buy first, or they want to buy first. They need to borrow $3 million. Their affordability of $3 million is zero. But their end debt position from the sale of their house will be zero. Their affordability of zero is 100%.
Good.
And a number of banks will accommodate that arrangement.
So we're always told we should be checking our rates. What would be a good way of, or how often should you actually be checking your rates, and what would be a good way of doing it?
And also, how does it happen? Because when we advise our clients and we put them into a loan, on day one, they're effectively getting the most competitive rate. But in a year's time, they're not as competitive as a new customer.
How does that work? Because if there's been a couple of interest rate rises, do they just rise a little bit extra than the interest rate?
So they've risen the same, but what's happened in that 12 months, each bank is jostling for a competitive position in the market. So then they put competitive offers out, may offer an incentive here. And what happens over a year, you as a customer who's been in the bank for 1 year drifts a little bit away from the market.
From the cheapest,
From the cheapest. And so the banks won't allow you to negotiate within each 12 months, only allow you once within every 12 months. The easiest way to do it is the anniversary of your loan.
Okay.
So with our clients, we have a prompt that comes up each anniversary, and we often, particularly in this environment, are going to our banks, on behalf of our clients, going to the bank. So it's only going to happen once a year, but you're not, so if a new customer is going to get an interest rate of 5%, and you've drifted to 5.4%,
right,
you're not going to get 5.
Yeah.
The banks won't.
What about all this cashback stuff? You hear 3,000, 4,000. Is that worthwhile thinking, or is that just a trick and it's not really that smart to be doing that?
It will disappear pretty soon.
Yeah.
I think it's very loss leading from the banks.
Yeah.
I think at the end of the day, some customers will change for $1,000 a year. Some customers will change for $7,000 a year.
Now, one thing that was, I believe, is a big moving beast, but people don't fully understand, is valuations. And without naming any names, recently we've just been through a very complicated deal, which, to be frank, wouldn't have happened if we weren't working together. But I think the biggest thing that people probably didn't understand was the variance that people have in valuations. A bank valuation is not a bank valuation, is not a bank valuation. They're not all exactly the same, in fact, miles apart. And in this particular instance, there was a 20% difference.
In this case, for this client, it actually did happen that way, that they were speaking to other advisors, and a valuation was triggered very early on in the transaction.
Yes.
The week after a purchase.
Yep.
And that valuation came in, as you say, 20% lower than a valuation that we worked through due process.
Yes.
And we undertook to speak to the valuer and understand his perspective of that property, that location, his thoughts. Has he valued there? Has he not valued there? Make him aware of a few comparable sales. Now, we're only presenting facts and gaining information about whether they were the right valuer. I think what was really important in this case, in this situation, was our client bought with a long settlement of 6 months.
Yeah.
And if we step back and think about, bank valuations generally last for 3 months.
Yeah.
And we had a falling market.
Yeah.
And a market that was very uncertain. Where were values going? And it was very hard for a valuer to put a figure on a particular property, particularly in this high-end area. And we actually chose a bank that was actually using a valuation period of 6 months.
Yeah.
So we didn't have to go to the market and get another valuation. If we were forced to by the bank and their lending policy, we could be in the position that the market might have fallen 10%.
Yep.
And our client was having to come up with more cash to complete the transaction.
Yeah.
And I think it's very important also to understand why valuations are so important in this space at the high end. Is the banks don't necessarily lend 80% of a $10 million property.
If you paid $10 million, they don't automatically say that we're going to lend you $8 million or something like that. Smart buyers and smart sellers. You see people that have acquired property. How do they become, over a period of time, really good at property? What's your sort of thought processes there?
I think they've got a plan and a long-term plan.
Yep.
And that plan might be 10 years. And they've got a vision, okay, well, I want to buy 4 properties.
Yep.
What do I have to do?
Mm-hmm.
And they start the plan on day 1.
Yep.
They don't start the plan in year 6.
Yeah.
And one of the things you said during our catch up is you've got, get in early.
Yeah.
Buy.
Yeah.
How do you accumulate property? You need equity and leverage to go again.
Mm-hmm. The people that know how to continually buy good property, that are after 5 to 10 years, they basically got $6 or $7 million worth of, we'll say 10 years, they've got $6 or $7 million worth of property and $1 million worth of loans or something like that, and they've got $5 or $6 million in equity. That they are the smart buyers and sellers. And to do that, I think the keys are that they buy properties looking for growth.
Yep.
They understand the cash flow, so you do need to be able to rent your property out and things like that. but equally importantly, they understand money. So they understand money that their tax and other little expenses, they're managed in depreciation, etc. They're managed in the right way, but they also have a really good relationship with their mortgage broker, so as they can get the loans that they actually need at the times that they need to be able to find the right sort of properties. I think that's a reasonable.
Yeah, very much so.
Well, Grant, this has been incredible. I really do hope that people have got a lot out of this. I'm sure they will. I know I've picked up a few more things that I didn't know. Thanks very much, mate.
See you later. Thank you.
Thank you.